Hey team, it's Matt from Universal CPA Review. Thanks for checking out this video where we're going to tackle a tough concept known as foreign currency. Now, it's broken up into two different types. The first one being foreign currency transactions, which are with external unaffiliated parties. And then we have foreign currency translation, which happens internally between the parent company and its subsidiaries. Now, before we dive into the video, please subscribe to our YouTube channel. If you haven't yet signed up for a free trial, why not, right? It's full access for 7 days. And then lastly, please ask us about any discounts or promotions, or you can also subscribe to the full access of the course for $99 a month. So why not give it a go? So are we ready to tackle foreign currency? Because I am. All right, team, we cannot put this off any longer. Today is the day we talk about foreign currency transactions and foreign currency translation. Now, these are difficult concepts. They are tested on the CPA exam, and it's just a hard thing to wrap your arms around. But guess what? We're here, we're going to do it together, and I'm going to make this as simple as possible for you. Now, before we dive into foreign currency transactions and foreign currency translation, we need to understand the basics, right? So we're going to start by talking about exchange rates. And there's really two methods that we can use to interpret exchange rates or quotes, right? It can either be the direct method or the indirect method. Now, we've all seen this before, right? So let's start with the direct method. It's basically a rate that tells you how much of a local currency must be spent to purchase 1 unit of a foreign currency, right? So since we're talking about the CPA exam for the US, we're always going to be talking about dollars, right? So in this case, right, if we use the direct method, we would say we need $1.23 in US dollars to get 1 euro, right? Now, the flip side of that is we could use the indirect method, which says, okay, for $1, well, that equals 0.81 euros, right? So we'll understand these more when we apply them to multiple choice questions and simulations, but that is the real basic way to interpreting foreign exchange quotes. Now, on top of that, there's different types of rates, and the two main ones we need to know are the spot rate and the forward rate. So the spot rate is for immediate settlement, right? It would be based on today. If I wanted to do this foreign exchange, right? I would go out and I would get the rate from some sort of exchange, and this is what it would tell me, right? And that's for immediate settlement. Now, with the forward rate, we're talking about out in the future, right? So let's say 30 days from now, here's what the exchange rate will be. Right? So companies will use a combination of the spot rate and forward rate in their normal course of business, right? So just be familiar with those terms. The other thing we need to know is types of currency, right? Can you identify the role of each currency in a specific situation, right? Because these will be thrown around a lot, and we need to know the basics, right? So the three main forms that they like to express currency in would be the local currency for a company, the functional currency for a company, and then the reporting currency for a company. So those are the three that we definitely need to know. Now, the local currency, that's going to be based on the national currency based on their location, right? So wherever the company is located, well, the location there, right, whatever currency is considered the national currency, that would be the company's local currency. Now, how is that different than the functional currency? Well, US Gaap defines the functional currency as the primary economic environment, right? So sometimes the local currency and the functional currency can be the same, but other times they can be different. Right, and we think about the primary economic environment, that's basically what the company's revenues and expenses are primarily in. Now, there's a lot of interesting methods that can be used to determine a company's functional currency. We don't necessarily need to know all of those methods or really any of them. We just need to understand the difference between the local and functional currency. And oftentimes, the question will give us hints like, basically, their operations are in this type of currency, and we know that's the primary economic environment. The last type is the reporting currency, and this is basically what the presentation of the financial statements would be in, right? This one's a little bit more straightforward. It will typically say The reporting currency is the US dollar, right? And most times, because again, we're talking about the US CPA exam, the reporting currency is going to be the dollar. So we're always going to have to start with some other currency that is the local or functional currency and then convert it to the reporting currency. Now, this is going to be different based on different situations. And the two methods that we need to understand and what this module really focuses on are going to be foreign currency transactions and then foreign currency remeasurement and translation. So we'll get into those, but the basic idea here is that foreign currency transactions are between a company and an unaffiliated third party, right? Somebody that's completely unrelated, like a vendor or supplier or a customer. And then foreign currency remeasurement and translation, that happens within the company, right? So if a parent company has foreign subsidiaries, well, they would need to remeasure and or translate those financial statements to when consolidation occurs, right? And we have the overall parent company financial statements. So that's the basics, and that's what we're going to really focus in on this module. Foreign currency transactions are transactions that occur with an unaffiliated third party, right? So if you're buying something from a supplier or vendor and they invoice you in a different currency other than what you would consider to be your reporting or functional currency, then that means that is a foreign currency transaction. And when we go ahead and evaluate the exchange rate, well, we use the spot rate, which is the rate or the exchange rate on the day that the transaction occurs, right? And if there's a change in that spot rate between periods, well, the company would recognize a gain or loss, and those are reported in the income statement. So in a foreign currency transaction, there are really three different stages that we need to be aware of, right? So as you can see in the visual, well, we'll use dates here, right? So let's say that on October 1st, year one, we purchase goods from a supplier. Now that's the initial transaction date, and we receive the invoice. Now, assuming that invoice is denominated in a different currency, well, we would use the spot rate to go ahead and record the value of that invoice in our financial statements. Now, let's say that a number of days go by before we actually pay it, right? Because most invoices are due in 30 or 45 days. And when we actually pay the invoice, that's the settlement date. So in this example here, let's say that's April 1st, year two, right? That's quite a few months later, but ultimately we pay the invoice. And again, when we go ahead and pay that invoice, well, on the day that it's paid, we use the spot rate. Now, there's likely going to be a difference between the initial transaction date and the settlement date for the spot rate, and that's going to result in a gain or loss. Now, the other date that we have to be aware of is any financial reporting date, right? So let's say that the company reports their financial statements as of the year ended December 31, year one. Well, on that date, we would use the spot rate again to go ahead and value what that invoice payment would be, right? So there's really three dates that we need to factor in, and every time we go ahead and figure out the change in the spot rate, right, that's going to result in a gain or loss. So hopefully this makes sense. The key point here is that foreign currency transactions, they always occur with unaffiliated third parties. We use the spot rate to go ahead and record the initial invoice, what the invoice would be worth as of the financial reporting date, and then when we actually go ahead and settle that invoice with cash. So let's go through an example because it will make a lot more sense. So in our example, we have Joey's Pizza Company. They make the best pizza in the US. Now, where did they get their materials? Well, of course, they purchased them from a supplier located in Italy. Right, so this purchase of materials, it occurred on December 15th of year one. Now, the invoice from the supplier had an amount of 23,000 euros, and Joey's Pizza did not pay the invoice until January 15th of year two, right? So we have basically a lag between the invoice date and the settlement date. But guess what? There's one more thing, and that's that we have a reporting date in between, and that's December 31, year one. Right, so what we're going to have to do is use these exchange rates go ahead and initially revalue the invoice in dollars when we record it, then revalue again at the reporting date, and then revalue again when the settlement occurs and Joey's Pizza actually makes the payment for that invoice, right? So we're going to go through 5 steps. We're going to look at the journal entries and the calculations. It's going to be very straightforward by the time we're done with this. So in our first step, we just need to convert that invoice amount in euros to US dollars using the spot rate, right? So if it's 1 euro is 1.4, right? That means we need $1.4 to buy 1 euro, right? So it's going to be higher, right? So we just multiply by 1.4, and that tells us the amount in dollars on December 15th, year 2, is $32,200, right? Now, since Joey's Pizza is purchasing inventory, it's going to be a debit to inventory and then a credit to accounts payable, right? So straightforward journal entry, just got to know to multiply basically the invoice that's denominated in euros by that spot rate, and that gets us the amount in dollars. So now we can move forward to the reporting date. And guess what? We need to revalue again using the spot rate on the reporting date, which is December 31, year 1. And when we look at the rates, right, it's now 1 euro is $1.25. So the dollar appreciated, meaning we need less dollars to buy 1 euro, right? So we'd expect the invoice amount in dollars to go down. And what happens when we do that? Well, it's 23,000 euros times that spot rate of 1.25. That means the AP amount in dollars now is 28,750. Right? And so step 3, we can see that when we compare that to the prior AP amount on the initial invoice date of 32,200, well, that results in a gain on foreign exchange of 3,450, right? Joey's Pizza is expecting to pay $3,450 less. So what we need to do is reduce the amount that invoice is on the balance sheet, which is why we have a debit for 3,450, and then the offsetting credit is a gain on foreign exchange for the same amount of 3,450, right? So that's an important journal entry to understand. So when you see a scenario that has a reporting date in between the invoice date and the settlement date, well, we're going to have to perform that step. But if there isn't one, we can move straight to the settlement date, which we're going to talk about here in step 4. So now we're on the date that Joey's Pizza is actually paying this invoice. And again, we use the spot rate, right? And this time it's 1 euro is equal to $1.30, right? So we again multiply 23,000 euro invoice by 1.3, and that tells us Joey's Pizza actually made a payment in dollars of $29,900, right? So in step 5, when we compare that to the prior invoice amount, right? Well, that ends up being actually more than what we thought. So that results in a loss on foreign exchange of 1,150. Right? You see what I mean? On our balance sheet, our invoice was 28,750, right? But we actually made a payment of 29,900. So we're paying more than we thought we were going to based on the latest spot rate. So that's not good for Joey's Pizza. That's a loss on foreign exchange of 1,150. So the journal entry, right? Well, we need to remove that payable. So that's why we debit the amount from the reporting date of 20,750. A loss is a debit as well, right? It's similar to an expense or any other loss we incur. So that's the 1,150. And then we actually have to credit cash as well for the cash that's being paid out. And that's the 29,900, right? So that's all of the journal entries and calculations that need to be made for basically a transaction that has the invoice date, a reporting date, and a settlement date. Now, if we go back to the question, right, it also asks what amount of gains and losses are recorded in years 1 and 2. Well, we had that foreign exchange gain from December 15th, year 1 to December 31, year 1. So that 3,450 would be a gain in the year 1 financial statements. And then in the year 2 financial statements, we have this loss on foreign exchange of 1,150. So also important to understand that. But that is a foreign currency transaction, occurs between a company and an unaffiliated party like a customer or vendor. So now we're going to talk about foreign currency remeasurement and translation. This is an extremely difficult topic to conceptually understand, but it's even more difficult to actually apply in the real world. I can't tell you how many times I worked with experienced professionals, CPAs that have been CPAs for 20 years, and they still don't understand this topic. Now, the CPA exam, they love to test you conceptually, so that's what we're going to focus on. And we'll go through an example later on. But really, the first part I want you to understand here is basically this two-step approach for remeasurement and translation. So we're going to start with step number one, which is remeasurement, right? And as you can see at the top and on the left, it says subsidiary, right? So this is only specific to a subsidiary of a company, and this subsidiary must be foreign based, right? So let's assume that their financial records are in the local currency. Well, in order to be consolidated with the parent company, we need to first remeasure the subsidiary's accounting records, which are in the local currency, to be in the functional currency. Now, sometimes the local currency and the functional currency are the exact same, but sometimes they're different, right? Now, the way US Gaap defines functional currency is pretty vague. It's just the currency that they use to do business, right? What's their primary currency that they use for cash inflows like revenue, and then cash outflows for expenses like paying their employees or paying their suppliers, right? So fairly vague, but you'll find a recurring theme in this module about trying to identify the functional currency. Now we'll get to an example in a bit, but let's just assume that the local currency and the functional currency are different, right? So we need to remeasure the subsidiary's accounting records. Now we're going to use a variety of different exchange rates, which again, I'll show you in a minute. But basically, if we have any gains or losses related to remeasurement, those are considered foreign currency gains or losses, and those are recorded directly to the income statement in the period incurred, right? So if we need to remeasure the year two financial statements, well, any gains or losses related to remeasurement are reported in the year two income statement. So we're done with step number one, and now we have the subsidiary's accounting records in the functional currency. Now, what happens if the parent company uses a different currency as their reporting currency, right? Meaning they report the consolidated financial statements in, let's say, US dollar, right? So in this visual, the functional currency was the euro, but the parent company reports in US dollars. Well, the parent company's financial statements, everything has to be in US dollars. So how do we get the subsidiary's accounting records, which are now in the functional currency, into the reporting currency of the US dollars? Well, we call this translation, right? And this is step number two. So when we translate the financial statements, again, we'll use a variety of exchange rates for various accounts, and we'll end up with some sort of cumulative translation gain or loss. Now, the key thing to remember here is that those gains and losses are reported in other comprehensive income and not the income statement, right? And if we remember from earlier modules when we talked about other comprehensive income, we had our FUPI mnemonic, right? And the F in FUPI, well, that was foreign currency translation gains or losses. So these translation gains and losses are going to other comprehensive income, which is part of stockholders' equity on the balance sheet, right? So they're not going to the income statement. The exam loves to really test whether you know, does remeasurement gains or losses go to the income statement or OCI? We know it goes to the income statement. And then translation gains or losses. Does it go to the income statement or OCI? Those go to OCI, right? So remember the fundamental difference here. Now, this is a perfect situation where we have to do both remeasurement and translation. But this is only the case because the subsidiary's accounting records are in a local currency, which are different than the functional currency, and then the functional currency is different than the reporting currency. Now, if either of those were not the case, then we might not have to remeasure or we might not have to translate, right? So be on the lookout for those scenarios because, again, the exam loves to test conceptually whether you know how to apply remeasurement and translation to a specific scenario when you have to factor in all these different types of currencies, meaning the local currency, the functional currency, and the reporting currency. So that was a lot to take in. Now we're going to go ahead and apply it to an example, right? So as you can see in the example, it says Mozzarella Corp, which is a wholly owned subsidiary of Joey's Pizza, maintains its accounting records in francs, right? Now, due to all of Mozzarella's branch offices being in Italy, right, because that's where pizza comes from and that's where the best cheese is, its functional currency is the euro, right? So they start by maintaining their accounting records in francs, which would be the local currency. But now we're saying the functional currency is the euro, right? So we could have had to identify it, but it told us because the branch offices are in Italy, right? That's where they're going to receive a lot of their revenue, pay their expenses. That's why the functional currency is the euro. Now later on, it says that Joey's Pizza uses the US dollar as the reporting currency for the consolidated financial statements. So again, we know that the reporting currency is now the US dollar. So if we look across the board here, right, we see that the local currency is the Swiss franc, right? And then we have the functional currency for Mozzarella Corp, which is the euro. And then the reporting currency for Joey's Pizza's consolidated financial statements is now the US dollar, right? So we have three different types of currencies. That means we're going to have to apply both the remeasurement and translation, right? The two-step approach to get basically the subsidiaries' accounting records in US dollar for consolidation. So going back to the example, right, it says remeasurement of Mozzarella's year 5 financial statements resulted in a $5,000 gain. Right, so how are we going to treat this? Well, when we're going from the local currency to the functional currency, right, that's remeasurement. And if you remember from our visual, all remeasurement gains and losses, those are recorded directly to the income statement in the period that remeasurement occurred, right? So that's going to be for year 5. So we're going to put that $5,000 gain directly to the income statement in year 5. Now for translation gains or losses, which it says resulted in a $10,000 gain, right? That's going to be recorded to other comprehensive income, OCI, which is not part of the income statement. It's part of stockholders' equity on the balance sheet, right? So for translation, that $10,000 gain, that's going to other comprehensive income, right? So this is a great example. It's modeled off of several AI CPA released multiple choice questions that focus conceptually on can you understand the difference between the local currency, the functional currency, and the reporting currency, and how to treat any remeasurement or translation gains and losses, right? We didn't really have to do any calculations here, and that's because they're pretty hard, right? So focus on this example, remember it, remember Mozzarella Corp and Joey's Pizza, and you'll be sitting there on exam day going, I got this. So now that we understand remeasurement and translation at a conceptual level, well, I mentioned that we need to use exchange rates to go ahead and remeasure and translate the financial statements. But what makes remeasurement and translation tricky is that we use different types of rates for different accounts in our financial statements. So let's go ahead and tackle remeasurement first, right? So as you can see in the visual, remeasurement, which is also known as the temporal method, well, we can either use the current or spot rate, the historical rate, or the average rate. And then on the left side, you can see we have different buckets of accounts, right? So we would use the current rate or the spot rate for items like cash, accounts receivable, accounts payable, right? Debt, anything that's more monetary in nature and more current, right? And then we would use the historical rate for items like PP&E, intangibles, inventory, equity, right? And then for items like sales and expenses in our income statement, we would use the average rate because that occurs over the period of time, right? So the average rate could be based on the monthly exchange rate, the quarterly exchange rate, or the annual exchange rate, right? Any company can use any method they want, but we take the average exchange rate over a period of time rather than at a point in time. But then you'll notice cost of goods sold, depreciation, amortization, those are based on the historical rate. So be familiar with the different types of rates and how they apply to different types of accounts, because again, this is a conceptual area that the exam loves to test. Do you know what type of rate we should use for a specific account when we're remeasuring, right? So be familiar with it. I wouldn't say memorize it, but think about the buckets here and then try to understand conceptually why we would use different rates. And then for translation, which is also known as the current rate method, well, this is a little more straightforward in the sense that all assets and liabilities we would convert using the current or spot rate. And then for equity, which mainly consists of common stock and additional paid-in capital, right? Those are the two accounts that we need to basically convert. We would use the historical rate. And then for the entire income statement, right, all revenues, expenses, everything, we would use the average rate, which again became based on the monthly average, the quarterly average, or the annual average, right? So again, exam, they love to say, hey, here's this asset account, right? Let's call it inventory or accounts receivable. Do we use the current rate, the historical rate, or the average rate, right? So you'll see some multiple choice questions in this module that directly relate to this, right? But again, it's more conceptual. Do you understand the different types of rates and how they apply to different types of accounts in our financial statements?